You're watching Power and Currency, the channel that maps where institutional power meets monetary architecture, where we don't just track price, we track the structure beneath the price. And right now, that structure is showing a fracture that shouldn't exist in any rational market. Welcome back. Here's the paradox the financial media isn't explaining. Silver spot prices have collapsed from their January 2026 peak of 121.67 per troy ounce to current levels trading near 80.50 as of May 8th, 2026. That's a 33.8% crash in roughly 90 days. Futures markets are in backwardation. Every major financial outlet is running headlines about the silver bubble bursting. Analyst consensus is calling this a speculative unwind. The technical traders are pointing to broken support levels. The narrative is unified. The silver rally is over. But here's what the cable news desks aren't telling you. While spot prices cratered, physical premiums at major dealers hit record highs. Delivery times extended from 2 to 3 days to 4 to 8 weeks. Allocated storage programs stopped accepting new deposits. The U.S. Mint suspended Silver Eagle production for the third time this year. European refineries are quoting 12-week lead times for industrial orders. And London Vault operators are implementing new encumbrance verification protocols that have never existed in the modern bullion market. Stay with me, because what I'm about to walk you through isn't a conspiracy theory. It's a documented structural dislocation between the paper pricing system and the physical settlement system that has now reached a scale where major institutions are publicly acknowledging what they've privately known for months. The global silver market operates as two separate markets that are increasingly pricing different realities. Every claim in this script is sourced. Every data point is verifiable. And by the end, you'll understand exactly why silver can be crashing and unavailable at the same time, and what that tells us about the architecture of modern commodity markets. Let's begin. First, let's establish the baseline. The price action is real. This isn't a phantom crash we're imagining. On January 29th, 2026, COMEX silver futures printed an intraday high of 121.67 per troy ounce. That was the highest nominal price in silver's recorded trading history, exceeding even the Hunt Brothers spike of January 1980, which peaked at approximately $49.45 per ounce in nominal terms, equivalent to roughly $185 in 2026 inflation-adjusted dollars. The rally that led to that January peak was extraordinary. Silver entered 2025 trading near $28.40 per ounce. By January 29th, 2026, it had gained 328% in 13 months. The velocity was unprecedented. Gold, by comparison, gained approximately 94% over the same period, moving from roughly $275 to $4,020 per ounce. Silver outperformed gold by a factor of 3.5 to 1. That performance ratio had no modern precedent outside of the 1979-1980 Hunt squeeze. Then came the collapse. Between January 29th and February 6th, 2026, just 8 trading days, silver crashed 38.4%, bottoming at $75.02 per ounce. The drawdown was violent. Leveraged retail positions were liquidated. Financial media declared the bubble popped. Bloomberg ran the headline, "Silver's Speculative Fever Breaks." The Wall Street Journal published an analysis titled, "How Retail Traders Lost $47 billion in the Silver Crash." CNBC interviewed strategists who called the top inevitable and telegraphed by fundamentals. Here's what made that crash particularly significant. It occurred without a corresponding catalyst in the physical market. There was no sudden supply discovery, no major mine announced a production surge, no government dumped strategic reserves. Industrial demand hadn't collapsed. In fact, photovoltaic solar demand, while forecast to decline in 2026, remained structurally elevated compared to 2023 levels. Indian festival buying was just beginning its seasonal cycle. Chinese manufacturing PMI was expanding. The crash was a paper market event. Specifically, it was a forced liquidation event triggered by COMEX margin requirement increases implemented on January 27, 2026, 2 days before the peak. The CME Group raised initial margin requirements on the 5,000-ounce silver futures contract from approximately 9% of notional value to 18.5%, and then to 22% on February 2nd, as volatility continued. Per the official CME clearing advisory, this was characterized as a volatility-driven risk management adjustment. Here's the mechanism. When margins double, leveraged long positions must either post additional cash collateral or liquidate. The January silver rally had been heavily driven by retail participation through futures, options, and leveraged ETFs. When margins spiked, the capital base couldn't meet the calls. Forced selling triggered stop-loss orders, which triggered more selling. Classic liquidation cascade. But here's the critical structural detail that the financial media completely missed. The crash didn't resolve the physical supply deficit. The World Silver Survey 2026, published by the Silver Institute and Metals Focus on April 15, 2026, documents that the silver market ran a cumulative deficit of 762.1 million troy ounces from 2021 through 2026. That's 23,705 metric tons drawn from above-ground inventories. The 2026 deficit alone is forecast at 46.3 million ounces, 15% larger than 2025's deficit of 40.3 million ounces. Read that again. The deficit widened in 2026 even as prices crashed. That's not supposed to happen. In a normal commodity market, a 38% price crash should trigger demand destruction and supply increases until the market clears. It didn't happen. Instead, what we got was a paper price collapse while the physical supply-demand imbalance actually deteriorated. The first cliffhanger is this. The silver price crashed 38% in 8 days without any change in physical fundamentals, driven entirely by margin-induced forced selling in the futures market, while the underlying supply deficit that caused the rally in the first place not only remained, it got worse. Stay with me, because the second fracture is where the paradox becomes impossible to ignore. While spot prices were collapsing, something unprecedented was happening in the retail and wholesale physical markets. Premiums exploded to levels that made the 2020 COVID shortage look minor. Let's define terms. Spot price is the benchmark trading price for immediate delivery of 1,000-ounce commercial bars in the London over-the-counter market, or COMEX warehouse-eligible material. Premium is the additional cost above spot that buyers pay for fabricated products, smaller denominations, delivery and dealer margin. In normal markets, premiums on retail silver products range from $1.50 to $3.50 per ounce over spot. During the 2020 pandemic shortage, premiums spiked to $6 to $8 per ounce. By February 2026, the same month spot crashed to $7,500. Retail premiums at major U.S. dealers hit $12 to $18 per ounce for standard Silver Eagles and generic rounds. That's not an isolated anecdote. That's documented pricing from SD Bullion, JM Bullion, APMEX, and Money Metals Exchange. At peak dislocation, some dealers were quoting $22 per ounce premiums on specific government coins. Let me make this concrete. On February 10th, 2026, spot silver was trading at approximately $76.50. A retail buyer attempting to purchase a single American Silver Eagle was quoted prices ranging from $88.50 to $94.50, depending on dealer and quantity. That's a 15.7% to 23.5% premium. A buyer attempting to purchase 100 ounces of generic silver rounds was quoted $89.50 to $91.80 per ounce, still 17% to 20% over spot. This wasn't price gouging. This was supply constraint. How do we know? Because delivery times extended dramatically. In a normal market, online bullion orders ship within 2 to 3 business days. During February and March 2026, dealers were quoting 3 to 6-week delivery windows. Some products were listed as available for pre-order, with delivery dates extending into late April. Money Metals Exchange published a customer notice on February 14th, stating that due to unprecedented demand and global supply chain constraints, orders may experience delays of 4 to 6 weeks. Layer this against the U.S. Mint data. The United States Mint suspended production of American Silver Eagles on February 18, 2026, citing insufficient supply of silver planchets from authorized suppliers. This was the third production suspension in 2026. Previous halts occurred in January and March. Per the Mint's public statement, this represented an extraordinary and ongoing challenge in sourcing the volume of silver blanks required to meet demand. Think about that timeline. Spot prices crashed in early February. The Mint suspended production in mid-February because they couldn't get enough physical silver during a price crash. That inverts every supply-demand model in classical economics. Now let's look at the wholesale and industrial side. Multiple European silver refineries, including Heraeus, Argor, Heraeus, and Valcambi, were quoting 10 to 14-week lead times for new industrial silver orders as of March 2026, according to Metals Focus reporting. These are the institutions that supply industrial manufacturers, jewelry fabricators, and large-scale institutional buyers. A 10-14-week lead time means if you're a solar panel manufacturer in Germany and you need silver paste in March, you're not getting delivery until June at the earliest. Compare that to normal operations. Standard refinery lead time for industrial silver is 2 to 4 weeks. We're seeing a 300 to 400% extension in delivery windows, while prices are down 33% from peak. Now layer in the vault dynamics. Per reporting from Laurie Williams at Sharps Pixley and analysis from Adrian Ash at Bullion Vault, several London Bullion Market Association, LBMA, allocated storage programs implemented new restrictions in February and March 2026. Specific vaults stopped accepting new allocated storage deposits, citing capacity constraints. Others implemented encumbrance verification protocols, requiring clients to demonstrate legal ownership chains and affirm that stored metal was not subject to lending, leasing, or hypothecation agreements. This is technical language for a significant development. Allocated storage means you own specific bars with specific serial numbers. Those bars are supposed to be yours, segregated, and unavailable for bank lending. The fact that vaults are now requiring verification that allocated metal isn't encumbered suggests they've discovered that some allocated metal was actually being double counted, claimed by clients as segregated, while simultaneously being lent out by banks. The second cliffhanger is this. Retail premiums hit 23% over spot during a price crash. The U.S. Mint suspended production 3 times in 5 months. European refineries extended industrial delivery times by 300%. And London vaults implemented unprecedented ownership verification protocols. All of this while the financial media was declaring the silver bubble over. Stay with me, because the third fracture reveals the mechanism driving this paradox. Here's what you need to understand. The global silver market doesn't function as a single integrated market. It operates as 2 parallel markets with different participants, different settlement mechanisms, and increasingly different prices. Market 1, the paper market. This is the COMEX futures market, the LBMA over-the-counter unallocated market, and the London forward market. This is where price discovery happens. This is where institutional traders, hedge funds, and commercial banks transact. Settlement is overwhelmingly in cash. Per Bank for International Settlements data, approximately 93 to 97% of silver futures contracts settle financially rather than through physical delivery. As of February 18, 2026, COMEX registered silver stood at approximately 27.1 million ounces. Open interest represented 800 plus million ounces of notional exposure. That's a coverage ratio of roughly 3%. Market 2, the physical market. This is where coins, bars, industrial silver, and allocated vault holdings transact. Settlement is in metal. Fabrication bottlenecks, mint capacity limits, refinery backlogs, vault encumbrance audits, all of these operate in the physical market, not the paper market. And these 2 markets are now pricing different realities. Now let's add the India factor. India imported approximately 185 million ounces of silver in 2025. On April 1st, 2026, the Reserve Bank of India authorized silver as bank collateral under a 75% loan-to-value framework. This effectively monetized silver inside India's banking system. Simultaneously, Indian imports froze for 5 weeks due to customs uncertainty. Domestic silver prices tripled year over year. Silver is being locked into bank vaults as pledged collateral. If even 10% of Indian household silver enters the banking system, that's 48 or 64 million ounces removed from circulation. This is structural demand. Now layer in ETF outflows. $3.2 billion exited silver ETFs in early 2026. Institutional capital is de-risking. Retail buyers can't access metal. COMEX February deliveries hit 42.1 million ounces, 165% above normal. Metal is exiting COMEX and relocating to London vaults. The system is functioning, but as a transfer mechanism out of transparent exchanges into opaque vault systems. Now the bearish case. Maybe fabrication bottlenecks explain everything. Maybe ETF selling is smart money exiting. Maybe India's freeze is bureaucratic. Maybe premiums compress. Maybe the deficit is overstated. All plausible. But here's the structural raid. Silver is transitioning from a unified market to a fractured one. Paper silver trades at $80. Physical silver trades at $92 to $102. COMEX registered inventory, 27.1 million ounces. February deliveries, 42.1 million ounces. ETF outflows, 3.2 billion. India import freeze, 5 weeks. U.S. mint production down 44%. European refinery lead times, 10-14 weeks. These are not normal conditions. Silver is now 2 assets. Paper silver, physical silver. One crashed, one didn't. The structure changed. And until fabrication, logistics, vault systems, and collateral frameworks reintegrate pricing, the spread remains. Pay attention. Invest with structure, never with speculation. This is Power and Currency. We'll see you in the next one.